Welcome back to Investing Talk Podcasts.
Today, we're looking at SOFI Technologies.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. I mean, the core narrative here is it's a fascinating story of corporate transformation. We are moving well beyond that initial story, of just a niche student loan lender.
Oh, absolutely.
What we're really witnessing is SOFI's impressive metamorphosis into this fully integrated and profitable digital finance platform.
And that profitability piece is huge.
It is. And what truly validates this strategy is the operational discipline we're seeing in the financials. Q3 2025. That marked their 8th consecutive profitable quarter.
8 quarters?
8. That isn't luck. That's proof of a sustainable, well-executed business model in what is a very competitive sector.
Right. Achieving 8 quarters of profitability, especially for a company like this that relies so much on consumer credit and tech integration, it just signals a kind of maturity that a lot of its peers, they just haven't reached yet.
Exactly.
It suggests they've gotten through that difficult transition from, a hyper-growth startup to a scaled, cash-generating business.
Oh, that's a great way to put it.
So let's focus on those Q3 2025 fundamentals because the top-line numbers are certainly compelling. Net revenue hit $962 million. That's a substantial 38% increase year over year.
A huge jump.
And the profitability metric is just as impressive. Net income was a robust $139 million, and adjusted EBITDA that jumped 49% year over year to $277 million. Those figures don't just indicate growth, they point to accelerating profitable growth.
And the efficiency of that scaling is really what we need to focus on, particularly how it's affecting their margin health. I mean, in Q2 2025, they hit a net profit margin of 13.5%, which demonstrates that operating margins are not only positive, but they're rising as the platform matures. But the real strategic nugget here is the business mix.
The non-lending side.
Exactly. The non-lending segments, which generate that highly desirable fee-based recurring revenue, contributed over half of total revenue in Q3, and they spiked 57% year over year.
That structural shift, moving away from total reliance on their loan book, that has to be the biggest de-risking factor, wouldn't you agree?
Oh, 100%.
It changes the whole valuation thesis. When more than half your revenue is that recurring fee-based income, you start getting valued more like a technology platform and less like a traditional, interest rate sensitive bank.
Exactly. And that whole transition is heavily supported by the other key advantage they have, their balance sheet strength, and of course the bank charter.
Right, the bank charter.
Unlike so many of their fintech competitors, having their own bank, SOFI Bank, it gives them direct access to low-cost funding through member deposits. This enhances their funding flexibility dramatically, lowers their cost of capital, and it directly supports that positive free cash flow. It's a foundational competitive moat.
It essentially cuts out the middleman, right? It removes the need to rely on, securitization markets or external financing partners, which must save them significant margin on every single transaction.
It does.
So given that capital efficiency, what is management focusing on for future deployment?
Well, management has made it really clear that because of these strong capital reserves and, their diversified earnings, they have a lot of flexibility.
So what does that mean? Buybacks? Dividend?
It could mean strategic capital deployment like share buybacks if the stock lags, or maybe a dividend way down the line. But right now, the emphasis is on doubling down on high ROI growth spendings, specifically expanding product features, and increasing the reach of their B2B tech segment.
Makes sense.
And their low net debt relative to EBITDA just reinforces their resilience, which is crucial in, uncertain markets. If we look at the bigger picture, the reason they can achieve all this, this operational efficiency and this shifting revenue mix, it lies in their unique design, which they call the Financial Services Productivity Loop.
The FIPL. We've heard that phrase before, but how does it actually work for the average customer? What does this integrated system look like in practice?
It's really brilliant in its simplicity. They acquire a high-quality member, usually a young professional who's looking for maybe a student loan refinance or a personal loan.
Got it.
Once that customer's on the platform, they're immediately cross-sold these really sticky non-lending products, a high-yield checking and savings account, maybe a credit card or an investment account.
And it all works together.
Because everything is built on that single tech stack, the data just flows seamlessly, which allows the platform to continually offer the next best product for that member's financial life cycle.
So it's about making it frictionless to move from one product to the next. The value isn't just in the initial loan, it's maximizing the lifetime value of that member by capturing, well, their entire financial wallet.
Precisely. And this ties directly into their dual revenue streams. You have the direct-to-consumer lending and banking business, driven by that FEPL, but then you have the B2B technology segment.
Which is Galileo and Technisys.
Right. And this is often overlooked by investors who are just focused on the consumer loans.
So let's unpack that B2B side a little.
Right.
What exactly are Galileo and Technisys, and why do they diversify the risks so effectively?
So Galileo and Technisys are core financial infrastructure providers. You can almost think of them as the operating system for digital finance.
Okay.
Galileo is a program manager and card issuing platform. It's the tech that allows other fintechs and banks to launch digital accounts, issue debit cards, manage payments. Technisys is a next-gen core banking platform. Essentially, SOFI is selling the very technology stack that enabled their own success, their proprietary code, to other financial institutions.
Wait, so they're not just competing with other banks, they're actually powering their competitors and collecting fee revenue from them.
That's it.
That's an extraordinary hedge. It gives them exposure to the entire growth of the fintech sector, regardless of whether a specific competitor succeeds or fails, as long as they're using SoFi's tech.
That's the definition of a true two-sided moat. It insulates them from direct competitive hits and provides a globally scalable source of recurring revenue that doesn't carry the same credit risk as consumer loans.
And on top of that, their brand engagement seems really strong, especially with younger, digitally native demographics. That leads to extremely sticky customer relationships.
Which just reinforces the FIPR model and keeps those customer acquisition costs relatively low.
And technologically, they've often been ahead of the curve, right? They have first-mover advantages in integrating things like fractional share trading, crypto access, all into a single app. That broad, integrated offering. It adds a lot of defensibility in what is a very crowded market.
Absolutely. The complexity of trying to replicate their fully integrated structure, having the consumer interface, the B2B tech rails, and the bank charter, it's a massive hurdle for any potential competitor. It takes years and billions of dollars to build that.
So shifting gears a bit, let's talk about how the market has reacted to all this. Looking at the technical performance, the stock has been, well, explosive. It's been trading recently around that $29 level. We're seeing sustained bullish sentiment with a phenomenal year-to-date return of plus 105%.
And a one-year return of plus 159%.
Just sharp outperformance compared to most of its fintech peers.
And the technical picture, it clearly validates that operational success. The stock has consistently traded above both its 50-day and 200-day moving averages for most of 2025, which is, it's the classic sign of a sustained bullish trend.
Can you elaborate on the momentum indicators? What are things like the RSI and MACD telling us in the context of this price action?
Certainly. The RSI, the Relative Strength Index, has been oscillating mostly in the 60 to 70 range. For a high-growth stock, that's a very healthy zone.
So not overbought.
Exactly. It signals strong buying interest without being technically overbought, which might indicate a pullback is coming. It suggests there's still room for upside. And likewise, the MACD, it remains positive and above its signal line, which just confirms that the short-term buying pressure is stronger than the long-term selling pressure.
We do have to address the volatility, though. The beta is quite high at 1.94. It's nearly twice as responsive as the broader market. So for listeners, that means bigger daily gains, but also bigger daily losses when the market pulls back.
That's absolutely true, but the market often accepts higher volatility for these high-growth, high-conviction turnaround stories. And despite that high beta, the recent trading activity, which has stayed firmly in that bullish range of $26 to $33, it indicates stable accumulation and strong floor support.
Investor confidence seems high pretty much across the board. On the insider front, we've seen no large insider sales reported in the latter half of 2025. In fact, there have been recent insider buys from the CEO and other directors.
Which is the best signal you can get, really. It shows internal confidence in the company's trajectory.
And that confidence is being echoed externally. Institutional investors are steadily increasing their stakes, and retail sentiment remains overwhelmingly bullish. SoFi has been a top trending stock on platforms like Reddit and StockTwits.
It has. And looking forward, we see several high-impact catalysts on the horizon, starting with the confirmed short-term events, in the next 0 to 3 months. The most critical is the Q4 2025 earnings report, which is due on January 30, 2026.
What are the market expectations for that earnings call beyond just the basic growth projections?
The market's going to be laser-focused on 3 things. First, maintaining or accelerating that year-over-year growth. Second, continued demonstrable progress on profitability. And third, detailed color on the scaling of those high-margin, fee-based segments.
The non-lending revenue.
Exactly. Any guidance beat or strong commentary there will likely fuel more upward price movement.
And we also expect significant product launches before the year wraps up, right?
Yes. The tech pipeline is loaded. We're expecting further expansion of their SOFI crypto offerings, integrating more coins, maybe structured products, and a major rollout of new AI-powered financial planning features.
The AI piece could be huge.
Given their massive data set from the FATPL, leveraging AI to offer personalized financial guidance could be a massive differentiator. And management has also hinted at getting regulatory green lights for expanded lending licenses in new U.S. states, or even initial overseas licenses.
That brings us to the exciting part. The long-term drivers and the market buzz. Long-term, the expansion of that B2B fintech segment via Galileo and Technisys, that remains the colossal driver projected for the first half of 2026.
And the market chatter is certainly intense. There's unconfirmed talk of further B2B fintech M&A where SOFI could acquire a smaller competitor, or a potential overseas expansion push into the EU or UK digital banking market.
But the most exciting speculation, the one that could fuel a big short-term surge, revolves around a potential major tech partner announcement. If SOFI integrates its full banking suite, the infrastructure, the deposits, the lending, into a major retailer's platform or a big tech platform,
That would be a game changer.
it would instantly grant them access to tens of millions of new users without spending a dime on direct customer acquisition.
That kind of partnership would fundamentally change their growth trajectory. It would position them as an embedded finance backbone, not just a consumer-facing app. But with such high growth and soaring valuations, we have to pivot and address the risks head-on.
Okay, let's do it.
The primary company-specific risk is execution risk. I mean, the management team has to sustain this rapid scaling across two completely different business segments, consumer banking and B2B infrastructure, while justifying the current valuation. Integrating Galileo and Technisys? It's a massive operational undertaking.
And as a lending institution, credit risk is always there. They're fundamentally exposed to macro swings in consumer credit quality and the impact of higher interest rates on borrowers. If the economy falters, the loan book takes a direct hit.
However, we do need to look at their mitigation strategies. SOFI primarily targets high FICO score borrowers, often professionals with lower than average loss rates. Their proprietary underwriting models, which use hundreds of data points beyond just credit scores, they provide a buffer against that generalized macro risk.
And management's track record has been strong.
Very strong. Their disciplined history of hitting or beating guidance and their strong cost control, it provides reassurance against that basic operational risk. They have shown that they know how to control the levers.
And on the sector level, fintech competition remains, well, brutally intense. They're fighting for wallet share against legacy institutions like Chase and Bank of America, but also against new, hungry disruptors. It's an arms race for features.
And because fintech valuations rely so heavily on future growth expectations, they are notoriously sensitive to macro shifts, especially interest rates and any sudden regulatory updates. Any tightening of lending regulations could slow down their biggest revenue driver.
But the key distinction for them remains that operational outperformance. Compared to many peers who are still struggling for consistent profitability, SOFI has displayed remarkable resilience, leveraging that integrated model to withstand market pressures.
So we've analyzed the transformation from niche lender to integrated fintech giant, we've reviewed the robust financials, and explored the dual revenue stream moat. The question for investors is no longer if they can execute, but really, how fast can they scale these high-margin businesses?
That's the crux of it. The company's robust loan growth, recurring profitability, and innovative product portfolio position it extremely well for continued expansion. But here is the final provocative thought we'll leave you with. Considering how quickly that high-margin, high-growth B2B segment Galileo and Technisys is growing, and its potential global scalability, how quickly will SOFI's technology segment eclipse its lending segment? And what does that mean for their ultimate valuation multiple compared to traditional tech giants, not just banks?